Hello future CS, welcome back to my channel again. So today we'll be solving the case scenario 7 from the case scenario booklet. So if you are watching my channel from a long time now, by now you must be aware that I have created a separate playlist as solving MCQs from case scenario booklet FR. So there I'll be adding all videos relating to solving MCQs from case scenario booklet for CA final financial reporting. The link to that playlist is added in the description below. You can access the link from there. So grab your notebooks and pen and you can also start solving this case scenario along with me. Also guys, in case you are new to my channel, I request you all to subscribe and hit the bell icon below so that you can get notified whenever I post new videos. So guys, when you visit my channel in the playlist section, you can see there is a separate playlist for CA final exam. And there is also playlist for CA final auditing, CA final AFM, and also there is a playlist for this case scenario booklet where I'll be adding more videos by solving the case scenario questions. There is also a playlist as CA GPT for students. In this I have made some videos demonstrating different techniques in which you can use CA GPT while preparing for your CA exams. So please visit my channel and you can watch all of these videos. So first let's read out this case scenario and let's solve the MCQ one by one. Joy Limited wishes to calculate tax base of its liability and deferred tax as on 31st March 2025. The balance sheet has been adjusted by current tax expense. The extract of equity and liabilities portion of the balance sheet as on 31st March 2025 is as follows. Equity and liabilities. So let's see the extract of equity and liability now. So in this case, the company wants to calculate the tax base and deferred tax of its liabilities. Equity, share capital rupees 12 lakhs, accumulated profit rupees 7 lakh 37,438, revaluation surplus rupees 88,000. Long term liabilities, deferred income government grants rupees 40,000, liability for product warranty costs rupees 16,000, deferred tax liability from 2023-2024 rupees 22,162, current liabilities, trade payables rupees 7 lakh 64,000, healthcare benefits for employees rupees 70,000, current tax liability rupees 80,400. So total equity and liability amount to rupees 30 lakh 18,000. Note A. Government grants are not taxable. Government grants received in 2024-2025 is appearing in balance sheet. Note B. In 2024-2025, Joy Limited made a further provision for product warranty of rupees 5,000. Such provisions for product warranty costs are not tax deductible until the claims are paid or settled. During the year 2024-2025, warranty claims were paid or settled for rupees 6,200. Note C. During the year 2024-2025, Joy Limited introduced healthcare benefits for employees. The expenses are allowable as deduction in tax only when benefits are paid, but in line with Ind AS 19. Such liability is recognized in profit or loss when employees provide service. Assume the tax rate of 32% for the year 2024-2025. So let's see the MCQ one by one now. MCQ number 1. With respect to point A in the case scenario above, determine the tax base of government grants for the year 2024-2025. Option A nil, Option B rupees 40,000. Option C rupees 12,800 and option D rupees 27,200. So the applicable Ind AS here is Ind AS 12. However, in this question, we have to keep one thing in our mind. That is, the government grants are not taxable. So this means that they are not recognized as income for tax purpose either now nor in the future. So government grants are not taxable. The carrying amount is rupees 40,000. So this is recognized as a liability under deferred income. Tax base, that is amount deductible for tax. This is nil in this case because government grants are not taxed. So they are not deductible as income in the future. Since the government grants are not taxable, the entire carrying amount of rupees 40,000 does not lead to any taxable or deductible temporary difference, as this is excluded from the deferred tax calculation. So, because the carrying amount is rupees 40,000 and the tax base is technically zero, as this does not result in temporary difference, because the income is permanently exempted under the tax law. Hence, in this case, the correct option is option A, nil. This is the correct choice because tax base is not applicable in this scenario. The item is excluded from deferred tax calculation altogether. Hence, the tax base in this case is nil. Option A, 0. Now let's see the second MCQ. MCQ number 2. With respect to point A in the case scenario above, determine deferred tax on government grants for the year 2024-2025. Option A nil, option B deferred tax asset rupees 40,000, option C deferred tax liability rupees 12,800, option D deferred income, that is government grants will not be taxable. The Ind AS applicable in this case is Ind AS 12, income taxes. Deferred tax is recognized only for temporary differences that are expected to be reversed and impact future taxable profit. However, certain items are explicitly excluded from deferred tax treatment. So, as per Ind AS 12 para 22b, temporary differences do not include those that arise from government grants which are not taxable. So, in this case also, the question has mentioned that the government grants are not taxable. So, this means that if the government grants are not taxable, no deferred tax is required. The temporary difference exists, that is the carrying amount is 40,000 and tax base is 0. But since the grant will never be taxed, this is actually a permanent difference. However, since this item is excluded from deferred tax accounting, the correct option in this case is option D, deferred income. Government grant will not be taxable. Option D is the most accurate option as it clearly states the reason for exclusion. The reason is the government grant is excluded from taxation. Now let's see MCQ number 3. With respect to point B in the case scenario above, determine the tax base of liability of product warranty cost for the year 2024-2025. Option A nil, option B rupees 5,000, option C rupees 16,000 or option D rupees 6,200. So the relevant Ind AS applicable here are Ind AS 12 income taxes. Also another Ind AS applicable in this case is Ind AS 37 provisions, contingent liabilities and contingent assets. A provision, for example like product warranty, is recognized when the following criteria are met. A present obligation exists due to a past event and payment is probable and the amount can be reliably estimated. Now let's see what is the tax law treatment for this. It is mentioned in the question that the provision for product warranty cost is not tax deductible until the claims are paid or settled. Now let's note down some given data from the question. Carrying amount of liability, that is the closing balance, rupees 16,000. Further provision made during the year, rupees 5,000, that is new expense recognized in the books. Warranty claims paid or settled during the year, rupees 6,200. This rupees 6,200 is tax deductible for the current year. Since only actual payments are deductible, any remaining provision is not tax deductible yet. So now let's see the tax base calculation as per Ind AS 12. As per Ind AS 12, tax base is equal to amount that will be deductible in the future. Since the entire 16,000 is a provision not yet paid, it has not been allowed as deduction yet and it will be allowable as deduction only when settled in the future. But for liabilities, if no amount has been allowed yet, the deduction is allowed only when it is paid for. Hence the tax base is 0 in this case. Because the amount has not been allowed yet and the deduction will be allowed only when it is paid for. Because the liability will give rise to a future tax deduction and nothing has been deducted in tax yet. Correct option is option A nil. Now let's see the fourth MCQ. Question number 4. With respect to point B in the case scenario above, determine deferred tax on liability for product warranty costs for the year 2024-2025. Option A nil. Option B deferred tax asset rupees 5,120. Option C deferred tax liability rupees 5,120. Or option D liability for product warranty cost will not be taxable. So the Ind AS provisions applicable here are, first is Ind AS 12 income taxes. A deferred tax asset arises from deductible temporary differences. A deductible temporary difference is a difference that will result in amounts being deductible for tax purposes in the future when the carrying amount of the liability is settled. And deferred tax asset is nothing but temporary difference into the tax rate. And another Ind AS applicable in this case is Ind AS 37 provisions. Provisions like warranty costs are recognized in books when a present obligation exists. But for tax purposes, deduction is allowed only when the actual payment or settlement occurs. Now let's note down some given data from the question. Carrying amount of product warranty liability rupees 16,000. Tax base 0 as per calculation in question 3 and Ind AS logic. Therefore, temporary difference is rupees 16,000 minus 0 is equal to 16,000. Since in this case, the liability is not a deductible, but it will be deductible in future when it is paid. Hence, this creates a deductible temporary difference. Hence, this gives rise to a deferred tax asset. Now, let's see the deferred tax asset computation. So, temporary difference is rupees 16,000. Tax rate 32%. Hence, deferred tax asset is 16,000 into 32%, which is equal to rupees 5,120. Hence, the correct option is option B. Deferred tax asset rupees 5,120. This deferred tax asset represents future tax savings when the warranty cost is finally paid and deducted for tax purposes. So now let's see the fifth MCQ. Question number 5. With respect to point C in the case scenario above, determine the temporary difference as per Ind AS 12 on account of health care benefits of employees for the year 2024-2025. Option A, rupees 70,000. Option B, rupees 80,400. Option C, rupees 22,162. And option D, nil. So the applicable Ind AS here are Ind AS 19, employee benefits. This Ind AS requires recognition of employee benefit expense when service is rendered, not when benefits are paid. So a liability is recognized in the books when employees provide service, even if payment is made later. And another Ind AS applicable in this case is Ind AS 12, income taxes. So as per this Ind AS, temporary difference is equal to carrying amount minus tax base. Deductible temporary differences arises when a liability is recognized in the books before it is deductible for tax purposes. In this case, the liability is recognized in books as per Ind AS 19. But for tax, it is deductible only when it is paid, that is in the future. Now let's note down some given data. Carrying amount of healthcare benefits, rupees 70,000 as recognized as per Ind AS 19. Tax base 0 because nothing is deductible until payment is made. Therefore, temporary difference is equal to rupees 70,000 minus 0 is equal to 70,000. Hence, the correct option is option A, 70,000. This temporary difference will lead to the creation of a deferred tax asset because it results in future tax deduction when the liability is paid. Now let's see the sixth MCQ. Question number 6. With respect to the point C in the case scenario above, determine deferred tax on healthcare benefits for employees for the year 2024-2025. Option A, nil. Option B, deferred tax liability rupees 22,400. Option C, deferred tax asset rupees 22,400. Option D, healthcare benefits for employees will not be taxable. So the Ind AS applicable in this case will be, first will be Ind AS 19, employee benefits. This requires recognition of expense and liability for employee benefits, that is healthcare, etc. when the employees render service and not when it is paid. And another Ind AS applicable is Ind AS 12 income taxes. A deferred tax asset arises from a deductible temporary difference. Deductible temporary difference is equal to when the carrying amount of the liability is greater than its tax base. And tax base of such a liability is zero when the expense is not yet deductible for tax purposes. Example, because when the payment has not yet been made. So now let's note down some given data from the question. Carrying amount of healthcare benefits liability rupees 70,000. Tax base is zero because deduction is allowed only on payment as we discussed above and not on accrual. Temporary difference rupees 70,000 minus 0 is equal to rupees 70,000. So this is a deductible temporary difference as the tax deduction will be available in the future when the benefits are paid. So now let's see the deferred tax calculation. As stated earlier, this will lead to a deferred tax asset because tax deduction will be available in the future when the benefits are paid. So deferred tax is temporary difference into the tax rate. So temporary difference is 70,000, tax rate 32%, hence deferred tax asset rupees 70,000 into 32% is equal to rupees 22,400. Hence the correct option is option C, deferred tax asset rupees 22,400. This deferred tax asset will reduce future tax liability when the healthcare benefits are actually paid and then they become deductible for tax purposes. Hence, this benefit is recorded as a deferred tax asset today. So that's it guys for today's video. We have solved all the MCQs relating to case scenario 7. So I hope you found this video informative and helpful. In case you found this video helpful, please share and like the video and also subscribe to my channel for more such CA guidance tips and videos. All the best for your exams. Happy studying and I will see you all in the next video.